Hello and welcome to our third and final webinar in Trustees Week, where with the help of the experts from SCVO's free legal and tax advice services and from Inspiring Scotland, we hope to give trustees the practical tools and information they need to survive and thrive during these very challenging times. My name is Tracy Bird and I run the SCVO Trustees Network, which is sponsored by Rathbones Investment Management, whose support enables us to run these webinars. So thanks to you all for joining us today. And just to note that this webinar is being recorded and will be available later on the SCVO website. We've also got closed captioning enabled, but if you'd rather not see that, my colleague Joanne will put instructions in the chat on how to remove it. So organisations are facing greater demand from the people we help, as we're all affected by the cost of living crisis. SCVO has created a running cost crisis hub with information and resources to help. And we hope this webinar today will provide you with some guidance on specific challenges and help you build resilience and financial sustainability. We're going to email out all the slides from today, along with further resources. And just before our speakers begin, I wanted to explain how our free VAT and tax and legal advice service can help SCVO members with an income of less than £500,000. So if you've got a query on anything from employment law to property, a constitution or VAT and tax, or anything in between, you can access support through our partners, which include Azets, Anderson Strathern, Brodie's, Burness Paul, Gillespie McAndrew, Mac Roberts and Turton Connell. And I have to say, they're all great to work with and they give such a lot of support to our members and the sector. So do put questions in the Q&A as we go. But if there's anything of a sensitive nature that you'd rather take offline, then you can email me afterwards and we'll see how we can help. So we've got a really busy agenda, so we're going to get started. And I'll introduce our speakers as we go, and they can tell you more about what they do when they speak. First up is Gavin McQueen from Burness Paul, and he's going to look at HR and employment challenges. Over to you, Gavin.
Thanks, Tracy. Hi, everyone. Delighted to be here today. I'm just going to pull my slides up and get started. Can everyone see that okay?
Yeah,
perfect. So, yeah, as Tracy said, Burness Paul, we are one of the SCVO helpline firms. So I've been working with the helpline probably for the last 2 years now. Helped out a lot of organisations along the way with kind of all variety of employment law issues. And today I am covering off HR and employment law points in the cost of living crisis. I'm a senior solicitor at Burness Paul, and I work specifically in the employment law team. And like Tracy said, if you've got any kind of specific queries that you want to pick up afterwards, then do please go through her or contact me directly and I can see how we can try and help out. So I'm going to run through a couple of points here and then I've got some time for Q&A at the end as well, either on the topics covered or anything else. I can't give specific legal advice on the call, but as I said, if you want to get in touch with me afterwards, then please do feel free. So I've got 5 points that I want to touch on in terms of support that can be given for employees and what organisations might have to be looking at right now. Since COVID, there's obviously been a massive change in the workforce, in the third sector and across the economy. We've seen a battle for talent. We've seen the Great Resignation, people no longer accepting terms that, they think are unfavourable. People want more flexibility in their roles and, they want to feel that they're being effectively remunerated and rewarded for the work that they do. So the first thing that I think organisations need to look at are wages and benefits. And I know that's a really difficult point because ultimately money is tight for everyone right now, for employees, for organisations, there's rising costs everywhere. And this could be one of the areas where it is difficult to make that change. But unless you're having competitive packages with other charities or other people in the sector, or even other employers, then there might be a difficulty in retaining talent. I think over the last 2 years, flexibility became more important, but now with the cost of living and the increase in prices everywhere, wages are again coming sharply into focus. So I think anything you can do on the wages front to offer an improvement, and again on the benefits front, then that would be massively important for retention and recruitment. In terms of benefits, that could be basic things. It can be cycle to work, improved pension contributions, and any other kind of scheme that can be put in place. Again, I appreciate that depending on size of organisations, then options might be limited, but if there's anything you think that can be put in place in addition to contractual terms, then that's always something that you want to look at. The next point I've got on my slide is tax efficiency. So if there's anything that can be done in that respect for individuals working with the organisations, the main one I would kind of touch on is salary sacrifice and that being looked at. So that is ultimately a reduction in salary, but can overall end up meaning that less tax is paid, and it could be in return for something like increased pension contribution or another benefit that might be covered. It won't be suitable for everyone, but it might be something that can be flagged to employees and might be something they want to look at. Next point I want to touch on is flexibility, and I've covered this in an SCVO webinar before, but I think right now with the move to working from home, flexible and hybrid working, then flexibility is something that organisations really need to look at. It's becoming a kind of accepted standard for most workplaces now, and people are really expecting that in terms of going to roles, and even more so now with the cost of living increasing. Things like train fares, petrol are becoming increasingly more expensive, and people may now want to work at home more regularly to cut down on those costs. So I think that's something that organisations need to look at with their employees. What kind of flexibility can be offered, and can demands and expectations in relation to coming in be changed. External resources might have to be looked at as well. That can cover off things like employee well-being, financial support, and other mental health resources. Again, there's a plethora of stuff available online. You might have your own external providers that you use, but if there is anything like that, then that should be signposted to employees. Employees might need all the help they can get right now, so anything additional to what's already being offered in-house is definitely a great resource. And the final point I want to touch on, and it's not something that organisations or any employer really wants to be thinking about, but it might be the reality of it now with the cost of things increasing. Ultimately, there's greater costs for organisations, funding could be cut or not guaranteed, and we are now forecasted to be going into recession. And I think realistically, potential restructuring and redundancy is something that needs to be in consideration. Need to ensure that you're prepared for that, and getting it right is really important. So any employee with over 2 years service has unfair dismissal protection. Redundancy is a potentially fair reason for dismissal, so that would give protection in that respect, but any process still needs to be done fairly. So there needs to be consultation, there needs to be fair selection, there needs to be alternatives considered. And the other thing to flag is that whilst it's only employees with over 2 years service that have protection from unfair dismissal, that doesn't mean that a redundancy couldn't be, for example, say discriminatory for someone with a disability, based on race, based on gender, based on sexual preferences. That could still mean that ultimately someone is protected in terms of redundancy if the selection criteria isn't fair. So it is important to get it right, and you do also need to think about any collective consultation requirements. Again, may not be applicable to all organisations depending on size, but if you're looking at over 20 redundancies within a 90-day period, then the collective consultation obligations are also engaged. But it's something just to be aware of. Ultimately, redundancy is a worst case scenario, and it's not something that you want to be taking lightly, but it is something worth flagging given the increased pressure on organisations and their funding right now. So that's all I wanted to cover off in terms of the main points. So I'd be happy to take a quick few questions since I've still got a wee bit of time left.
Thanks, Gavin. Yeah, do put your questions in the chat. I'm just going to highlight that the SCVO HR and Employment Service has a lot of templates, policies, model policies on our website. So do use them if you can. I would just say probably it's about planning ahead, Gavin, would you? And not waiting until things are really dire before you seek help?
Yeah, definitely. I mean, it's the same as anything right now. You know, organisations are having to put planning in place, and HR and employment issues are just another facet of that. But yeah, you know, I think getting ahead of it and being proactive rather than reactive is definitely advisable. Like you said, sometimes when you're reactive, you know, often the damage is done, or it can be difficult to recover it from there. If you've always got one eye on the future and trying to future-proof the organisation, then I think that's the best way forward.
Yeah. Okay, we don't have any questions up to now, but we might get some at the end. And I would just reiterate, if you do have anything you want to ask about, and maybe you don't feel that you can in this environment, do email myself or the SCVO Pro Bono service. Then the details are on our website about that. So thank you, Gavin. I'm going to now move on to Charles Hay from Brodie's, and he's going to look at what you need to think about property, either whether you're renting property, your own property, that kind of thing. So over to you, Charles.
Thanks, Tracy. Right, I will now share my screen. So Tracy, is that okay? Can you see the slides okay?
Yeah, thanks.
Great, thanks. So good afternoon. My name's Charles Hay. I'm a managing associate in our real estate department in Brodie's, based in Glasgow. I think I've been helping out so far as the SCVO Pro Bono referral scheme for the past couple of years, and delighted to have this opportunity just to present at today's seminar. So I'm looking at the property aspects with regard to these challenging times, and to touch on a couple of points which Gavin's also mentioned before, which you'll see is flexibility is something which I will mention as well, and is key to how we're going to work our way through these challenging times. So using the same format again as Gavin mentioned, I'm going to just go through a couple of slides and make a couple of comments, and then have a chance for some questions at the end, hopefully. But if not, then my details will be there if anybody wants to contact me independently of this. So to first of all, just look at what you might be looking at if you're reviewing your property requirements. And we are probably, in terms of this seminar, really looking at situations with regard to leasehold interest, so where you are renting premises rather than if you're owning. It's easier to look at just what options might be available in that scenario. The sort of things that we're looking at, lease expiry or break date. So if you're coming to the end of your lease, what things do you need to be bearing in mind? And I'll touch upon that in a bit more detail in the next slide. Surrender of the lease. So if you're not nearing a break date or an expiry date, the other options that you might be looking at, one of which is approaching the landlord with the view to offering to grant renunciation of the lease, to basically give up the lease, return the premises to the landlord. Now, a couple of things that you would need to bear in mind so far as that's concerned. Obviously, this would be by way of agreement with the landlord. The landlord may well look for a reverse premium. There will probably be a dilapidations issue, so that's an issue concerning what is the condition of the premises that you're returning them in. Your lease will, I would expect, have repairing obligations. The landlord would look to those repairing obligations so far as ensuring the premises are coming back to them in a condition that is consistent with your repairing obligations, and that normally means returning the premises in good and tenantable repairing condition. There is also usually a tax submission perhaps to be made. Now, with most charities, you would be getting relief from land and buildings transaction tax as far as lease is concerned, but there's still an obligation to report termination surrender of a lease to Revenue Scotland, and that's something that sometimes can be missed. Another option, again, if you're not nearing a lease expiry or break date, is to see as to whether you can try and offload your liability under the lease by way of an assignation of the lease to another party. Or if you can't offload the liability, possibly look to do a sublease whereby you've got a subtenant in who will cover off the lease obligations that you would still be owing to your landlord. The key point with regard to looking at any sublease or assignation option is, what does the lease actually say so far as obtaining the consent of the landlord to that process. It is a fundamental provision that the landlord will be entitled to require you to obtain their consent unless the lease indicates that that is not a condition, but that would be unusual. And in most cases, if you are looking at a sublease or an assignation, the landlord's consent, usually the lease indicates that such consent's not to be unreasonably withheld or delayed. But the conditions of consent that a landlord would be looking at would normally relate to the covenant of the party whom you are speaking to. Do they have the necessary financial position to implement the obligations under the lease? Certainly, an assignation would not be consented to if the incoming assignee does not have the ability to show that they can perform the lease obligations. You may still be able to do a sublease. As I say, with that situation, you would still be on the hook to the landlord so far as the lease obligations are concerned, but you would have the contract with your subtenant whereby you could hopefully cover off the costs, the obligations owed to the landlord by those coming from your subtenant. Fourth option here, a license or sharing possession. So that's not going down the road of fully handing over the use of the premises to another party by way of an assignation or sublease, but sharing the possession or allowing another party to occupy the premises, but again, your relationship obligations would still be owed to the landlord, but again, you may be able to obtain some input in terms of financial, in terms of dealing with some of the obligations by way of sharing possession. Again, you need to check your lease as to whether you are allowed to do that and whether, as I say, you need the landlord's consent in that respect. In most cases, you probably do. And the last option there I'm just looking at is, can you agree a re-gear of the lease with the landlord? Sort of thing that I'm talking about there is perhaps agreeing to build in a break date that may not be there in your lease at the moment. A landlord may be willing to give you an option to terminate the lease early, maybe not immediately, but in a year or two. Sometimes, again, the landlord may look for a consideration in this respect. They may look to agree that there should be a review of your rent early in order to give you the break option. It's all about the commercial negotiations so far as that's concerned. Moving on to my next slide and just going back to this aspect of, sorry, I'm not doing very well there, the lease expiry or a break date. So if you're coming up to a lease expiry or a break date, what is the things that you need to be thinking about? It's essential, again, to check the terms of your lease. Is there a required period of notice in order for you to take advantage of either the break date, or if your lease is, for example, on an annual recurring basis, say a year-to-year basis, you may be entitled to terminate the lease at the expiry of the year, but more likely you're going to need to give a period of notice to your landlord. Sometimes it can be as much as 6 months, could be 3 months. You need to check the terms of your lease. Similarly, if it's a break date, so that you can exercise an option to terminate your lease early. Again, what are the conditions in that respect? How much notice do you have to give? Are there any other conditions in relation to that right to exercise the break, such as not to be in default of your monetary obligations, so have your rent all paid up to date, service charge, insurance. Vital just to check those points. If there's anything that I would hope you would take away from today's seminar in relation to property, it's about the situation whereby if you are in a lease that is initially for more than a year and there is no provisions so far as requiring to give notice in order to terminate, you do still have to give 40 days clear notice for the lease to expire, to terminate at the expiry date. If you don't give that notice, or if the landlord, again, doesn't give that notice, the lease will automatically continue for a further year. This is a principle called tacit relocation, and it catches out a number of tenants because the lease says it finishes on, say, for example, the 30th of November, they just think that come the 30th of November, that's it. But if that lease has been in place for, say, for example, it was a 5-year lease and it's got an expiry date of 30th of November, then if you've not served notice, then as at today, you would be in for another year because there is no longer the time in order to give that 40 days clear notice. You should also check with regard to the lease what it says about service provisions. If you're giving a notice under a lease, you may be required to do it by way of recorded delivery. There may be provisions which indicate whilst it's not prescribed to do it by recorded delivery, it is sufficient to do it by recorded delivery. That gives you the comfort that as long as you do it by recorded delivery, you've ticked that box and you've got yourself a valid expiry of the lease. Confirm you're serving it on the correct party. That's basically making sure that it is the person who owns the landlord's interest that you're serving the notice on. Now, again, if this is a sublease, then it's the tenant under the lease that you're serving it on rather than the landlord themselves. But is again, just being aware of who it is that you have to actually intimate the notice to quit on. Just as I mentioned with a break notice, there could be other conditions such as making sure that you're not in arrears for rent or you're not in arrears for service charge. Other points to consider, again, mentioned it before, with a lease expiry, you're likely to have a dilapidations situation. So the landlord may be looking to agree a schedule of repairs. You would need to check the lease as to whether you could just pay a sum of money in respect to this or whether you have to carry out the works. Reinstatement obligations, your lease will no doubt indicate that if you've made alterations to the premises, you may require to have these removed. And there's a question of when can you do it? Do you have to do it before the expiry date or can it happen after the expiry date? And it also mentioned the fact that there may be a tax return to do, simply again to notify Revenue Scotland that the lease has terminated. If you're looking at new lease terms, then again, one of the main points I would always look to do is to limit your repairing obligation to a schedule of condition. Flexibility is important, so break options, can you get, if it's a 5-year lease, would you have the right to terminate on 2 years? The reinstatement obligations, again, mentioned before. And similarly, looking going forward on a new lease, what is your ability to assign the lease, to sublet it? What control do you have rather than dependent upon the landlord's consent? And that's just a quick run through how you may be looking at your leases at the moment. Probably the most important point is just to be clear in terms of what actually is stated to be within your lease and just to know what your obligations might be in that respect. And as I say, I don't know if we've got time for any questions, happy to do that, or as I say, it can be dealt with maybe after.
Thank you, Charles. Awful lot of technical information in there. So I think the message from that is do take professional advice, definitely. No questions up to now, so maybe people are waiting till the end. But as I say, do put them in the chat as we go if you have any burning issues. I'm going to hand over to Scott Craig now from Azets, and he's going to talk about VAT and tax. Over to you, Scott.
Hello, everyone. I'm just double checking that everything's working here. I'm Scott Craig, obviously tax partner at Azets. My specialism is VAT, but today I'm going to cover some other taxes as well. Again, in a similar vein to Gavin and Charles, I've been involved with the SCVO for a couple of years, and we've been providing advice and assistance on a wide range of situations and issues. In the ideal world, as most kind of accountants, advisors, lawyers would say, we would be asked to confirm the position and be involved at an early stage, certainly ahead of any changes being implemented. In practice, what we're seeing at the moment is a number of voluntary organisations who are being a lot more creative in what they're doing. A lot are also looking at their existing arrangements, reviewing, refreshing, and looking to update what they've currently got in place. So as a result, the tax position may well be affected and can be planned for. So with that in mind, what I'd like to talk about, if you go into the next slide, I'd like to talk about 4 taxes in the main: corporation, employment, gift aid, and VAT. And actually, with kind of planned precision, some of the things I'll talk about tie into what Gavin and Charles have talked about already. Moving on to the first one, then the next slide, which is corporation tax. Basically, if you're a charitable organisation, and some will be, some won't be, you may well use a subsidiary. If you're using a subsidiary, then obviously any profits you make that you gift aid or you gift back up to the charity are tax free. So definitely a great way of saving some tax. If you don't have a subsidiary, be careful on the charges made between the two. Clearly, tax is going to be due, tax may be applicable, but again, using the costs that are in each organisation, you may well be able to reduce any tax liabilities that's applicable. And back to the charity, if you do use a subsidiary and you're finding the subsidiary maybe isn't as profitable or as worthwhile as it used to be, don't forget that you've still got that 80,000 limit of turnover before you have to start thinking about corporation tax. And even then, within a charity, if you don't make any profits, you won't be paying any tax. So we have gone through a number of with a number of charities and charitable organisations, the question of whether they need a subsidiary or whether it's worth keeping a subsidiary is something that a number of organisations are doing. I want to pick up on a few things on basically cashback or tax savings, and these are specifically well, the first one is the sale of properties. If you've got a charity that's selling properties and it reinvests any gain from that into the charitable activities and the charity, then there shouldn't really be any tax. If you haven't got a charitable status, remember that there are changes going ahead in April 2023. At the moment, any tax on any property sale or profit will be based at 19%. After the 23rd of after April 23, it's going to go up to 23%. That assumes there's no change in the budget on the 17th of November. And in a similar vein, there are changes that are affecting anybody with R&D expenditure claims and capital allowances expenditure claims. So with R&D is this fantastic arrangement where you can make a claim to reduce your tax liability based on costs you've incurred on research and development and developing new products and developing new ideas. There has been a little bit of discussion in the press about how people push it. So there have been a number of examples of people trying to be just too smart for their own good. But if you've got genuine R&D expenses, say for example of £100, you're basing your R&D claim on £230, which is quite significant, and you get to claim 14% of that as a tax credit. Now, if you don't have a profit to offset, you can actually claim it in cash back. Similarly with capital allowances, there's a super deduction at the moment, and that finishes in April 2023. So any improvements to buildings, mainly the contents or the plant and machinery, there's an extra 30% that you can increase the cost by. So definitely worth looking at those areas if you're involved in any or you're having to pay any corporation tax. Can I move on to the next slide, which is employment tax, and just picking up on some of the things that Gavin was talking about. Absolutely, reward and incentive for staff seems to be the key message, but because of the uncertain future, some organisation can't commit to putting down a salary, an extra salary cost. So bonuses seem to be a really good way of doing it. Obviously, they're a one-off bonus, and the next year you have to get reappraise the situation, but they seem to be going down pretty well. On the salary sacrifice arrangements, which Gavin mentioned before, pensions and electric vehicles seem to be flavour of the month as far as we're hearing. Certainly more organisations are looking at electric vehicles when they're replacing stock or replacing pool cars. The other idea is vouchers. So you can use salary sacrifice for certain vouchers as well. Again, as Gavin said, you maybe won't be giving people as much as much salary because you're deducting the salary, but they're going to get more for their money because these deductions are made before tax. I also flag up trivial benefits. So there's a limit of £50 for any trivial benefits, and if you're making kind of £50 payments for trivial benefits, those shouldn't be subject to any kind of employment tax issues. Again, you can do these, you can do a number of these in the year. If you want to look at it, please let us know, because there are conditions that you need to fulfill. And home working, which has been obviously in place for the last few years, what we're finding is that if you want to adopt this and not for it to be seen as a benefit, having a formal arrangement or agreement in place with your staff to emphasise that they are allowed to home work will mean that the employment tax position is minimised. I would also maybe flag up the changes to employed status, so that there's a number of organisations thinking about temporary 0 hours or self-employed people. Just remember the employment tax position. There have been a few cases recently, one involving Uber, which resulted in the biggest VAT assessment ever. I mean, it went into kind of millions. That some situations which you may think are kind of self-employed or not employees actually are, because they are kind of engaged in such a way that give them all the benefits of employment without perhaps the title. So just be careful if you're looking at changing status of any employment contracts. Quickly onto gift aid now. With gift aid, obviously, there's extra money that you can get from the government where donations of cash are received from taxpayers. I stress that because as time goes on and you've got funding arrangements in place with people or donations from people, sometimes the individuals change their tax status, so they may become retired and they may stop working, and if they stop becoming taxpayers, strictly speaking, you shouldn't be making gift aid claims on their behalf. So monitoring and reviewing any gift aid donations or gift aid arrangements you have is really important, and HMRC are becoming a little sharper on looking at the declarations and the paperwork you hold in place. I would also flag up admissions and memberships. Both of these situations usually have benefits attached. So again, by just reviewing the benefits, and this is an area, membership packages, patron schemes seem to be getting reviewed and revamped at this moment in time with an eye to generating more income, but also with an eye to kind of maybe bringing the benefits packages up to date. So if you're doing that, make sure that the benefits don't exceed the gift aid limits, so that you can still claim all the gift aid that you're possibly entitled to. There's also a link with VAT. So there's a kind of a weird juxtaposition where if something's done and provided for free, it's usually gift aidable. If, however, you start providing benefits, you've got to think about VAT. And if VAT is applicable and you have to account for VAT on something, then you can claim gift aid on the VAT inclusive amount. So again, kind of technical, but well worth kind of knowing. Second-hand shops, I would flag up as well that again, there should be really a declaration from the donor that they're quite happy that you will take the proceeds of the sale and use it as a donation. Therefore, you can claim your gift aid. Again, really paperwork, but if you get the paperwork in place properly and you think about the benefits and the I guess the mechanism that you've got there, you should be able to maximise any gift aid receipts from the government as efficiently as possible. The last section is VAT. So on VAT, as far as voluntary organisations are concerned, 9 times out of 10, VAT is a cost because you can't recover VAT or you can't recover all the VAT that you're incurring. So one of the first starting points is this to say, well, if you don't pay it or don't incur it at the standard rate of 20%, there's going to be a saving straight away. I will flag up that if you're using people who aren't VAT registered, you're not going to pay VAT. That, however, does open another door, and you've got to be careful in your situation. You've got to be careful that you're not spending or aware that the person's got kind of trade of more than £85,000 and isn't charging VAT, because that's just blatantly incorrect. Once they've gone over 85,000 of turnover, they should be charging and accounting for VAT. So by all means, go for people that aren't charging VAT, but make sure that in the background you've done your diligence on those organisations. As far as savings are concerned, there are some for charities. So advertising, you shouldn't be paying any VAT on charity advertising. Fuel and power, that's used for charitable premises. That's where you've got non-business use or residential use, should only be 5%, and there shouldn't be any climate change levy on that. If you're paying 20%, look at it, check it. If you've got specified goods for care and welfare activities, normally to help or assist people live in their own home, there should be 0%. But also, if you've got your own organisation and you're improving the property so disabled people can get around the buildings, there should be 0% or reduced rate VAT on some of those works as well. Property rental, which picks up on what Charles was talking about, you don't have to pay VAT on rental that you pay if you're using the property for non-business purposes. And if you're renting to other people, think about charging VAT, because that then allows you to recover VAT on expenditure. Similarly with construction projects, if it's a new build project, it's relevant charitable, relevant residential or dwellings, you shouldn't be paying any VAT on the costs or cost of construction. And again, if you do incur VAT, think about how you use the building. Could you charge VAT to recover VAT? Finally, for those who aren't charities, on the last slide, the organisations that are registered and do incur VAT and can't recover it all, now is a really good time to review your VAT recovery calculation. I'm willing to bet that your activities have changed, your income sources have changed, and therefore your VAT recovery position should change. And the organisations we've been looking at, in the main, the recovery is going up. There's also a thing called capital goods schemes. So if you spent more than 250,000 on a property in the last 10 years, it's worth having a look at that expenditure again, even going back for 10 years, because there may be scope to claim more VAT. Finally, last kind of 4 areas, bad debt relief. If you've got sales that you've accounted for VAT on that are unpaid, after 6 months, you can claim the VAT back, which is a saving for you. If you're raising invoices where you've got to account for VAT, you don't have to account for the VAT if you raise a pro forma or a request for payment, just not an invoice, or you enter into, if you're buying services, if you enter into self-billing arrangements, it will give you a VAT advantage, a cash flow advantage. Think about grant funding. If grant funding can be changed into a service or a supply and payment, you may be able to increase your VAT recovery. And the final, I guess, comment is that keep an eye out in the press and keep an eye on our website, because changes are afoot on the not-for-profit public sector VAT and tax position. They're trying to simplify everything. It may be a bit of a Titanic moment, but they're trying to simplify everything. They're trying to give charities a little bit more opportunity to save money. I don't know how quickly this is going to happen. The budget may give us some indication. If not, we'll keep pushing and lobbying HMRC for change. And I just want to emphasize at the very end, if you've got any questions or any tax issues that you come across, please give us a call. We're more than happy to have a conversation for no charge as part of the arrangement, and see if we can help you out and point you in the right direction. We'd rather have the conversation and it come to nothing than not have the conversation. Tracy?
Thank you, Scott. There was an awful lot there, and when you said about simplifying tax, I'm not sure how that would work, but there's a couple of questions in the chat, but can you answer them in the chat, Scott? Because I'm going to move on to Gillian now.
Will do.
From Anderson Strathern, and Gillian's going to look at mergers and collaborations. Thanks.
Thanks, Tracy. I'm a director in the public and third sector team at Anderson Strathern, so I focus on charity law, corporate governance, commercial contracts. I don't focus on IT and have had a bit of a disaster with my slides. So Joanna SCVO is being my glamorous assistant and clicking through them. Today, I've got about 5, maybe 10 minutes to talk about the slightly thorny subject of third sector mergers and the more palatable subject of collaboration. My first slide is a bit of a disappointment, actually. I was looking for an image from the Disney film Encanto, but pesky intellectual property rights stopped me from doing that. If you've got children or grandchildren under the age of 10, You've probably been driven mad by one of the songs from it. We don't talk about, well, we don't talk about mergers, very contrived way of saying that, but we don't. And actually in the current financial climate, I would just encourage people to put some of these discussions front and centre, not shy away from them, and look at measures as part of a range of potential measures that can be taken. Next slide, please, Joanne. So merger is seen as a bit of a dirty word, and I can totally understand that. I've worked with Scotland's third sector for the entirety of my career. We have such a wonderfully buoyant third sector, an army of volunteers, passionate founders. There's such a strong sense of mission and sense of commitment to those that we're trying to serve, our service users. All of those, myself included, to our charity trustees, understand that our core duty is to act in the interests of the charity. And so actually looking at merger, I can see that that runs counter to that. But if the alternative is that you are going to sort of limp on, have to deplete the services that you're offering, or potentially wind up, then I would say that it is something that should be considered in the interests of your service users, because actually becoming part of something larger with increased purchasing power can allow for you to maintain those services. Next slide, please. So yeah, key advantages and disadvantages. As I've said, if you are merging, it might allow that preservation or even the enhancement of the services you're already delivering to service users, rather than depleting them or having to wind up altogether. You've got economies of scale, increased purchasing power through being part of something larger, potential access to greater resources. If you're a small, say, Glasgow-based charity and you become part of a Scotland-wide or UK-wide charity, access to greater comms, greater fundraising capabilities and the like. Disadvantages, it is costly. It is one of the areas where you do need legal advisors and accountants. You might also find, as I've seen with a number of organisations post-merger, you discover that there is a poor cultural fit and mission drift. So if you are a charity that is working in the mental health sector, but specifically with people who have addictions, you move into a broader mental health charity, and then you find that their focus moves more to children and young people, and the really good work you were doing in addiction is lost along the way. That's something that actually it can be very, very disappointing, and there's not an easy exit strategy. I've had a number of trustees who have been on the boards of, say, Scottish charities, merged into UK charities. They've tried their best to enshrine in transfer agreements and in articles of association some kind of reference to the work that they were doing in Scotland. But after the event, they find it's not really panning out that way. But then they're on the board of the merged entity. Their duty is then to promote the success of that new merged entity. So it is quite difficult to unwind from it. Next slide, please. So if we are going to enter into a merger, how do we do it well? Quick fact check. What I'm talking about by merger is two or more legal entities coming together to form one, which will likely involve winding up of some of the organisations. So I've got some key tips based on my experience of how I think you can best effect a merger. Number one, I think mergers tend to work best when they're being initiated by those who are considering merger, rather than when it's been forced on you. So if you have a local authority that's issued 5 different service delivery contracts for mental health and wellbeing charities, all working in different pockets of that authority, and then the authority says, no, we want to reduce it to 1, you're sort of forced into a merger, and it can leave a very, very bitter taste. Due diligence, do your homework, make sure you do your due diligence properly. I don't just mean the legal due diligence with lawyers poring over contracts and pension provisions and the like. I'm also talking about the much softer due diligence, getting a sense for the cultural fit. How does this organisation treat their staff? How is this going to work post-merger? Number 3, communication is absolutely vital. You can see people in the early stage of merger discussions holding their cards very, very close to their chest. This is not going to work well if people do that. You will sometimes have people asking for non-disclosure agreements to be signed before they feel comfortable offering up more information. It's not something I particularly push myself, but if it's necessary, fair enough. But it can feel a bit like a prenup and things slightly getting off on the wrong footing. So horses for courses. And number 4, I would always advocate establishing a joint steering group to see the merger through, having representatives from the senior management teams of the relevant organisations and trustees. They are looking at all the key action points being hit and also looking at communications to the wider world around the merger. Next slide, please. So what are the key stages, just in terms of demystifying it a bit? The first is getting an outline business case and having that approved by the boards of those who are merging. This is looking at what is the USP of the merged entity going to be, how is it greater than the sum of its parts, and how are you legally going to give effect to the merger? There are different ways of doing it, which we don't have time for today, but it could be, are we going to set up a brand new legal entity and all the relevant existing organisations transfer into that? Highly unlikely in the current climate because it's too expensive. Far more likely, charity A or third sector body A transfers to organisation B, all of its assets and operations, and then winds up. You've got your due diligence exercise, and your due diligence exercise will actually help to determine the best route of merging, because it will look at what assets does organisation A have, what does organisation B have, which is the cheapest way to effect the merger. Oh, this one's got 3 leases of properties, this one's only got 1. So use as the ongoing entity the one that's got all the leases, because that would be more costly to transfer. Statutory consents, if any of the organisations are charities, you're likely looking at winding up one or more organisations, so the one that's transferring its assets, so you need OSCR's prior consent. For the recipient charity, it might be changing its name to better reflect the scope of what the merged entity does. Might also have to change its objects clause if its objects aren't broad enough to take on everything that's been transferred over from the transferor. Again, you need OSCR's prior consent for that. Next stage is, once you've got those consents, you'll need member resolutions, not board resolutions, member resolutions for winding up, for change of name, for change of objects. The big one for the lawyers is the business transfer agreement. That can all be negotiated in the background while some of this other stuff's going on. It's the contractual agreement from organisation A to transfer its assets and operations to organisation B for 0 consideration, for no payment. The stickiest bit in this tends to be the position around warranties and indemnities. Just a plea, if you are considering this, use a third sector, charities, lawyer, and traditional corporate finance lawyers tend to get their knickers in a real twist over the slightly unusual position on lack of warranties and on indemnities. What we normally say is, if this organisation is transferring everything over and they're not being paid for it, you need to protect the board of that organisation. So if any liabilities crop up after the transfer, it's the recipient that agrees to take the hit from them in broad terms. The transfer agreement itself will not give effect to all of the transfer. There are certain other things like properties, leases that need to be formally assigned, TUPE consultations and the like. So that's something else to be borne in mind. And then at the end of the process, the organisation that's been cleared out, if it's a company, it needs struck off the register of companies, and OSCR needs to be notified. Next slide, please. The nicer one, to collaborate or not to collaborate, that is the question. Next slide, please. It's not a direct alternative, collaboration, to mergers. Sometimes it can be a precursor, kind of trying things out, but very often it's where organisations have come across an opportunity that they cannot take on themselves, so they look to collaborate with others. One of the most common instances, which I'll use as a theme in this, is where there is a large-scale public sector contract that organisations are looking to bid for. It's more palatable than a merger very often, but a lot of groundwork is needed for this. Next slide, please. So the advantages: sharing of skills, experience and expertise to secure that contract from public sector commissioners that you wouldn't have been able to secure yourself, for example, access to competencies that you can't afford to buy in, and can enable a wider scope of service delivery. So again, if you are based in Glasgow, but there's a contract that's Scotland-wide, you can be working with Edinburgh, Lanarkshire organisations. Sharing of development costs and risk. Disadvantages: What we tend to see is, especially where it is one of these public service delivery examples, an invitation to tender comes out, people panic, throw together some sort of consortium, but don't really think through who's doing what, what's the share of the contract fee, how are we splitting the liabilities in this? So that is something to be borne in mind. They also can require quite a lot of intensive contract management to ensure that all organisations are doing what is necessary. Reputational risk is another one. If you're doing your bit well under a large scale contract, but others are not, you can all be tarred with the same brush. The flip side of that is you're doing something really well, but it's all under the banner heading of a consortium. So you might not be getting the brand recognition that you would like. If it's all being done purely on a contractual basis, so contract from public sector commissioner, and then the various organisations that are agreeing contractually among themselves who does what, you'll need a lead partner for that public sector contract. And they can be taking the hit. There are greater legal risks for them unless it's all back to back. Next slide, please. I don't know how much time I have left, probably not at all, but one of the key considerations is, are you going to do it all contractually, or are you going to set up an actual legal entity to form the vehicle for the joint venture? I've put in this slide and in the next slide quite a lot of material in this, which I suspect we don't have time to go through all of it just now. But broadly speaking, if you are going to establish a joint venture vehicle, like a separate legal entity, a joint company, that is more of a thing. It's a bit harder to disengage from it, but you've got a board which is then tasked with making that consortium successful, and it's that entity that enters into contracts and builds up expertise. So for something that is really, really committed rather than testing a toe in the water, I would say that is the better way of doing things. That's me, Tracy. I think I'm sort of vaguely on time.
Thank you, Gillian. No, that was great. There is a question in the chat around pensions, and I'm not sure whether you can answer that in the chat or maybe just give a few pointers. That would be great.
I haven't seen the question, but what I'll say is pensions are hideous when it comes to this and can be very much the deciding factor on how you go about the merger. It's not even directly Gavin's thing, because it would be more specialist pensions lawyers, but there can be a crystallisation of liabilities, especially where you've got local government pension scheme employees involved, but it is definitely one that needs specialist advice in terms of how you shape the merger.
Great, thank you. I think that was more or less what the question was. Just before I move on to Kenneth, who I'm hoping is going to do a roundup really and look at good governance and all of this, just to highlight, we do have another webinar on the 7th of December on winding up charities. So if collaborations and mergers don't work for you, you might have to think about that. And that can be booked through our website. Okay, Kenneth, over to you. You've got 5 minutes.
Thanks, Tracy. My name's Kenneth Pinkerton, and I am partner and head of charities at the third sector at Brodie's. I'm also a member of Scotland's Third Sector Governance Forum. The eagle-eyed amongst you will have noticed that I am not an accountant, so it's a little bit strange that I'm going to speak about the going concern basis of preparing accounts. So broadly, what is it? Well, and who has the responsibility for it? So I'll just read from ICAS guidance, and it's worth having a look at that on this topic. It's the responsibility of trustees to carry out an assessment of their charity's ability to continue as a going concern. In their assessment, the trustees should consider all available information about the future, covering at least 12 months from the date on which the trustees' annual report and accounts are approved by the trustees. So the first point to know there, it is the trustees. It is your responsibility as trustees to do that. So how do you do it, or what should you be looking for from your senior leadership team to give you that comfort? Well, what you're wanting to look at is your income and expenditure, and in the cost of living crisis, those we are seeing various things arising. So on the income front, you might get funding income. It's very difficult to get funding. Can you be as sure as you were last year going into next year that you're going to get that income? You may deliver services, you may have contracts. Will those contracts continue over the next 12 months? rental income. Charles has spoken about rents. Can you be as sure as you were last year that you're going to get the rental income? Fundraising income, where we are all seeing people being a little tighter with about what they spend their money on. So again, you might have to review the amount that you're putting in your cash flow to cover the fundraising income. Looking at the other side, looking at your expenditure, wages, inflation, people asking for more money, the squeeze is there. Loan interest rates are going up. So what we're seeing perhaps when you're now being asked to sign off as a going concern is the environmental and economic factors have significantly changed since last year. Your job as trustees is to prudently look at the cash flow statement and be satisfied, taking into account your reasonableness in terms of your charity trustee duties, so that you can sign off that audit letter and happily sign off the accounts to say that you will be a going concern for the next 12 months. From a governance point of view, I would urge you to look at Scotland's governance code for the third sector. There's good stuff in there under the leadership purpose and also the control purpose, just to make sure that you're discharging your duties properly. And I will stop there, conscious of time.
Thank you, Kenneth. That was great. Very precise and concise. Okay, I'm going to hand over to Elaine now. I've covered what SCVO can offer for members through our free advice services. Elaine's going to tell you what Inspiring Scotland can help with, and that's more longer term support as well. So over to you, Elaine.
Right, thank you. Okay, so I'm going to whistle through this. So for those of you who don't know, Inspiring Scotland's been around for, I don't know, 14 or 15 years. We work with over 700 charities throughout Scotland. So we're very much at the coalface, knowing what problems charities are facing. I'm going to skip over the video. I'm just going to talk to you instead. So the secret sauce of specialist volunteering is that we have a network of 500 professionals who are giving of their professional services for free. So similar to the SCVO scheme or arrangement with professionals, but ours is a little bit broader. So we have professionals who are lawyers, accountants, social media people, all sorts of skills, and those people are giving of their skill sets on an individual basis directly to the organisations. You don't have to be an Inspiring Scotland funded organisation to access this this network. Any of the 25,000 plus charitable organisations in Scotland and KICS and anyone basically, if you find out about it, you can come and get free advice from our network of professional volunteers. There's no form filling or anything like that. What happens is you simply get in touch with myself or my colleague, Tommy Seymour. It's all on our website. We have a little chat with you, and then what we do is that we match you to a volunteer who has the skill sets that you're looking for. Yeah, so it is very much a tailored service. We spend a lot of time talking. Just a little bit of a track record. These pinball men, as I call them, just show you the kind of areas that we have experts waiting to hear from you. They donated over 3,000 hours last year. I log all of those hours, and last year the total was over £650,000 worth of non-financial support. So that's what they gave away for free. We have roughly 29 requests a month, and we also have a very active trustee recruitment and also training service as well. So this is just a snapshot of one part of our website. If you Google specialist volunteering at Inspiring Scotland, you will find the whole site. So we can advertise your trustee vacancy for free. But then one of the things that I do is my pro bono to my, sorry, I'll just go back to the specialist volunteer network, is that I provide trustee training for free for any organisation. Again, it's very bespoke. I measure it, I make it specific to what you're wanting as outcomes. If you're wanting to frighten trustees that have been on your board for 20 years, I can do that, but very gently. If you're wanting to encourage and instill confidence in new trustees, I'm always delighted to do that. And just recently we've added a new string, if you like, to my bow, and that if there's boards with lived experience trustees on them, then I've also got some sort of separate training that I can do as well. And again, that is something that we deliver for free. Contact details are on the last of my slides. As I say, we do a lot of talking. It's a very, very tailored service. So just if anyone out there needs a little bit of help after they've exhausted the SCVO help, then just get in touch, and Tommy and I will be delighted to hear from you. So I'll just stop sharing. Thank you.
Thank you, Elaine. Yeah, I think if anything, this webinar has shown it is tough out there, but there is a lot of help out there. So do access free help and advice that we've covered today. We've run out of time, so thanks to all of our speakers today for their support and the excellent presentations. I'm aware it was a bit of a whistle-stop tour, so do let me know if you'd like to explore any of these topics in more depth, and we can plan some more webinars for next year. Certainly, we're going to look at VAT and be planning some SCVO members webinars in the new year. So today's session was part of a series of webinars to celebrate Trustees Week, and all of the recordings will be available on our website. We've also got a special offer we've launched this week for trustee recruitment ads. So during this month in December, you can advertise your trustee vacancies on Good Moves for free, and that will give you access to over 80,000 people who are actively looking for roles in the voluntary sector. I'll send more details about that in my email to you. So thanks for you all for joining us, and thanks again to our speakers. And remember, if you are an existing trustee, do join the SCVO Trustee Network. Thank you and goodbye.